When the Fed cuts interest rates, borrowing gets cheaper. Your mortgage, your car loan, your credit card, all of it eases up. That's the story everyone tells. And it's wrong often enough that believing it can cost you real money. Because the Fed doesn't set your interest rate. It sets exactly one rate. And what happens to yours from there is a chain, not a switch. Start with what the Fed actually does. There's no dial in Washington labeled mortgage rates. The Fed controls one thing, the federal funds rate. And even that name oversells it. The Fed doesn't directly set the federal funds rate either. It sets a target range, then steers the real rate into that range using its other tools. So what is the federal funds rate? It's the interest banks charge each other to borrow overnight. Banks have to hold a certain amount in reserve. At the end of the day, some are a little short and some have extra, so they lend to each other overnight to settle up. The rate on that overnight loan, bank to bank, is the federal funds rate. That's it. That's the number at the center of everything you read about the Fed. It is not a rate you or I will ever pay directly. We just live downstream of it. From that one overnight rate, everything else reprices, but at wildly different speeds and strengths. Start with the tightest link, the prime rate. Prime is what banks charge their most creditworthy borrowers, and it isn't really negotiated. By convention, it's just the federal funds rate plus about 3 percentage points. When the Fed moves, prime moves the same day, in lockstep. And a whole category of consumer debt is pinned directly to prime. Most credit cards, home equity lines of credit, plenty of variable rate personal loans. So when the Fed cuts, the interest on your credit card balance really does ease within a statement cycle or two, because it's bolted to prime, which is bolted to the Fed. This is the part of the simple story that's actually true. If everything worked like a credit card, the simple version would be right. But the biggest loan most people ever take does not work like that. Your 30-year mortgage does not track the federal funds rate. It tracks the 10-year Treasury yield. And the 10-year Treasury moves on something completely different. Expectations. The federal funds rate is an overnight rate. It's about right now. A 30-year mortgage is money lent for decades, so its rate reflects what investors think inflation and growth will do over years, not what the Fed did this afternoon. Which leads to the part that breaks people's intuition. A Fed cut can leave your mortgage rate exactly where it was, because the market saw the cut coming and priced it in weeks ago. Or stranger still, a cut can push mortgage rates up. If investors decide the Fed is easing too aggressively and will let inflation run hot, they demand higher yields on long-term bonds to compensate. And mortgage rates climb on the very day the Fed eased. It has happened before. It'll happen again. Now flip it around to the money coming in. The yield on your savings account, your money market, your certificates of deposit, those track the federal funds rate too, because when money is expensive between banks, banks compete harder for your deposits. Higher Fed funds rate, better savings yield. But here's the catch worth knowing. The pass-through is asymmetric. When the Fed hikes, banks are slow to raise what they pay you on savings. They're in no rush to give up the spread. When the Fed cuts, they're quick to lower it. The chain runs both directions, but the direction that benefits the bank tends to move faster. Knowing that is the difference between leaving money on the table and moving it. So when the headline says the Fed moved, picture what actually happens. The Fed pushes on one end of the system, a single overnight rate between banks. From there, it travels outward through a web of linkages. Some are tight and fast, like your credit card. Some are loose and stubborn and occasionally backwards, like your mortgage. The Fed doesn't flip a switch on your financial life. It pushes one rate, and the rest of the structure responds, at its own speed, in its own direction. Which means the question on a Fed day was never, did my rate just change? It's, which of my rates is tied to this one? How tightly? And what did the market already expect? Answer that, and a Fed decision stops being a headline you react to, and starts being something you can actually read. We cover the markets on the days that actually matter, with explainers when it helps. Hit subscribe so you don't miss it. We'll see you next time.